Something unusual is building in the silver market right now. And if you're not paying attention before Monday morning, you might wake up to a move that already happened without you. This past week has been one of the most chaotic weeks silver has experienced in years. Prices spiked, crashed, recovered, and confused almost everyone watching the market. But what most people are missing is that the real setup might not have happened during the week. It might be happening right now over the weekend. And by the time markets open Monday morning, the pressure that has been building beneath the surface could finally release in a way that catches the entire market off guard. Before we go deeper into what's happening, take a second to hit the like button and subscribe to the channel if you follow the silver market, precious metals, or global financial trends. Here on Past and Profit, we break down the big economic moves that most people only understand after they've already happened. The goal is simple. See the pattern early so you're not reacting late. Now let's talk about why Monday could be different. Throughout the entire week, the silver market showed signs of stress that normally take months to develop. At the start of the week, silver surged aggressively as geopolitical tensions pushed investors towards safe haven assets. That spike created excitement across the market. But just as quickly as the rally started, the market was hit with a sudden collapse. Margin changes, heavy paper selling, and algorithmic pressure sent silver sharply lower in a matter of hours. For many traders, that looked like the end of the story. A classic spike followed by a reset. But something strange happened after the crash. Instead of continuing lower, silver stabilized and began recovering almost immediately. Buyers stepped in faster than expected. Physical demand remained strong. The price started climbing back up, even while the market was trying to push it down. When a market refuses to stay down after aggressive selling pressure, experienced traders start paying attention, because that kind of behavior usually means the real demand is stronger than the visible price action suggests. Then another signal appeared that many people overlooked. Exchange margin requirements that had been increased earlier in the week were quietly reduced again. That single decision changes the entire dynamic heading into Monday. When margins are high, it becomes expensive for traders to open new positions. When margins are lowered, suddenly more participants can enter the market with the same amount of capital. In simple terms, the barrier to buying silver just got lower again. Think about what that means in practice. Funds that were forced to reduce positions earlier in the week now have the ability to re-enter the market. Traders who stepped aside during the volatility now have a reason to come back. And portfolio managers who track commodities as part of their allocation models may begin increasing exposure again. But here's the key point. Most of that repositioning does not happen instantly. It happens over the weekend while analysts review the data and traders prepare their orders for the next trading session. By the time markets reopen, a large number of participants may already be planning the same move at the same time. And when many participants attempt to enter the same market simultaneously, prices rarely move slowly. At the same time, another issue is creating uncertainty inside the physical silver market itself. Inventory levels across major exchanges have been drawing attention. When large amounts of metal are moved between different inventory categories, analysts begin asking questions about what it means for available supply. For the average viewer, this might sound technical, but the concept is actually simple. Silver stored in exchange vaults can exist in different classifications. Some of it is available for delivery to settle futures contracts. Some of it is simply stored metal that is not intended for immediate settlement. When large quantities move from one category to another without clear explanation, the market begins to wonder whether deliverable supply is tightening. And tightening supply changes the psychology of the market quickly. If traders begin to suspect that physical metal is becoming harder to access, the incentive to secure positions early increases dramatically. No one wants to be the last buyer when supply suddenly becomes scarce. While all of this is happening in the Western markets, another development has been unfolding on the other side of the world. Institutional analysts have been watching inventory transparency in Asian markets very closely. Whenever data reporting changes or becomes less clear, it creates uncertainty, and financial markets tend to respond to uncertainty by adding risk premiums. That simply means investors begin pricing in the possibility that something important could be happening behind the scenes. Over the weekend, research teams at banks, funds, and trading firms will be reviewing all of these signals together. They will be updating models, writing reports, and preparing recommendations for Monday morning. And when those reports land on trading desks, the reactions often happen quickly. But the economic backdrop adds another layer to the story that could amplify the move. One of the most important economic reports of the month is the employment data released in the United States. Every major asset class reacts to it. Stocks react, bonds react, the dollar reacts. And commodities like silver often react even more strongly. Why? Because employment data directly influences expectations about interest rates. If economic data shows weakness, investors begin expecting central banks to reduce interest rates sooner. Lower interest rates typically weaken the dollar and increase demand for hard assets like gold and silver. On the other hand, if employment data shows strong economic activity, something else happens. industrial demand expectations rise. And silver is not just a precious metal. It is also one of the most widely used industrial metals in the modern economy. Silver is used in solar panels, electronics, medical technology, electric vehicles, and high-performance computing hardware. Demand from these industries continues to expand every year, so strong economic growth can also support silver prices through rising industrial demand. That creates an interesting situation where both strong data and weak data can end up supporting the long-term outlook for silver, just through different mechanisms. Now add geopolitical uncertainty to the mix. When global tensions increase, investors historically move toward assets that hold value during uncertainty. Gold usually receives most of the attention, but silver often follows with even stronger percentage moves because the market is smaller and more sensitive to sudden shifts in demand. Throughout financial history, there have been moments when multiple catalysts appeared at the same time. Economic uncertainty, supply questions, policy expectations, and geopolitical tension all converging together. When those forces align, markets can move far faster than anyone expects. That's why the next trading session matters so much. By Monday morning, the market will have processed the entire weekend of analysis, headlines, and positioning decisions. Institutional research reports will reach trading desks, portfolio managers will finalize their allocations, and traders who have been waiting on the sidelines will decide whether to step back into the market. All of that pressure gets released at the opening bell. Sometimes the result is a quiet session, but sometimes the result is a sudden gap that immediately changes the tone of the entire market. And that's why experienced traders watch these moments carefully. Because the biggest moves rarely start when everyone is comfortable. They start when uncertainty is highest and positioning is most uneven. Right now, the silver market sits at a very interesting crossroads. On one side, there is strong industrial demand, growing global uncertainty, and persistent interest from investors looking for hard assets. On the other side, there is volatility, short-term speculation, and a market that has already experienced extreme price swings this week. When those forces collide, the next move can surprise both bulls and bears. And that is exactly why so many analysts are watching Monday's open. The question is not just whether silver will move. The question is how many participants are already preparing for that move before the market even opens. Because if enough traders reach the same conclusion at the same time, the price reaction can accelerate quickly. So as we head into the weekend, pay attention to the signals. Watch how markets react to economic data. Watch how investors respond to geopolitical headlines. And most importantly, watch how silver behaves when trading resumes. The first few hours of the next session could tell us a lot about where the market wants to go next. Before we wrap up, I want to hear your view as well. Do you think silver is preparing for a major breakout? Or do you think the volatility this week was just temporary noise in the market? Drop your opinion in the comments because the discussion here on past and profit is always one of the most interesting parts of these videos. And if you found this breakdown helpful, share the video with someone who follows the silver market so they can see what might be coming before the next session begins. Thanks for watching, stay sharp, and I'll see you in the next one.